Do you think it'd be crazy for someone to get into real estate right now?
No, this is the best time to get into real estate. It's my turn to ask the question.
Okay.
So, you know, because this is your side. How long, we're going a little higher for longer, right, with the Federal Reserve. How long do you think rates are going to be in a higher position? And when do you feel like they could change?
It's a good question. And, I have been pretty bullish on the fact that mortgage rates will start to improve before the end of the year.
Yep.
And we could find ourselves in, high fives, low sixes. The MBA has said 5.5 by the end of the year. I think that's a little optimistic. I was kind of high fives, low sixes, end of the year. That's been kind of my most recent, stance on this for some time. But I'm starting to feel like that may not happen as we move through the year here. And the reason, it's not that, look, no one has a crystal ball. There's no question. Nor does anyone claim to be. We take the best data from what we have to go from, and we, come up with what we think is going to happen. And, what has happened as planned is it didn't happen exactly as planned because May was a huge miss for CPI, but inflation has absolutely come down as we expected it to.
100%.
Again, didn't happen exactly as planned. We've talked about that plenty on this podcast, but inflation, and I just showed a chart about it in one of the last 2 episodes showing where it's at right now, which is pretty close to getting in line with what the Fed would want to see. The problem is that the employment numbers continue to disappoint. I mean, we are seeing unemployment claims, but we need to see them over, I think, like 380,000 a month in order to really move the needle. And we're just not seeing that right now. So the strength of the employment market continues to be resilient. And so what that has is the Feds over here with their rhetoric about continuing to raise interest rates.
Yeah.
In my mind, I do not see a direct correlation between what the Fed is doing and what mortgage rates should be doing. And the Fed will pivot quickly. You know what I mean? We've seen them on a dime just, oops, we just new data, like we're going a different direction. So that could still happen. But all that to be said, look, if you're buying mortgage-backed securities, if you're an investor in mortgage-backed securities, it's like anything, right? As more people want them, the prices go up and the yields go down. That's what creates low interest rates. So we need demand in mortgage bonds. Well, what creates demand in mortgage bonds is low inflation. And that hasn't changed as far as I can tell. So there's some other factors that are impacted the bond market, but inflation was what drove it up, and inflation, I believe, will still bring it down. I think the Fed's a little off their rocker, and they really, as I've mentioned in the past, really just want to stamp this out and say it's never coming back, and then they're going to dump a pail of water on it once the fire's out. So they're going to do what they're going to do, but as there's demand for mortgage bonds, rates will come down, and so but unfortunately, these employment numbers and the way the market's reacting to them because they know what the Fed's going to do because of them is really what's driving it right now. And we've seen rates tick up over 7%, in the last week. So last couple of weeks. So with that being said, I'm still optimistic, or I'm still, it's still my estimation that we see them lower by the end of the year. But I don't think that I think that we're not really going to see rates to a place where they're favorable enough that it's going to start unlocking this inventory and getting people to really want to do anything different. That probably looks like it's not going to happen. I don't know when it's going to happen. It could happen in the first quarter. It could happen later on in the year. But I think one thing that we need to think about, especially look, we have 2 audiences here. We have potential homeowners who may be watching this saying, is the market going to crash? Should I buy a house right now? Is now the right time to purchase? But a lot of the people who watch this podcast are mortgage and real estate professionals. And I think we want to speak to them for just a second, because if you're a mortgage or real estate professional, I don't, there's a lot of people who know more than I do about the market, but I know more than most, and I don't know what the answer is. So with that being said, I think that we're at a place where I would be playing the game as if rates may not drop until the end of next year.
100% agree. I think this is the market where you hear what the Fed is saying, you hope for low interest rates next year, and you mentally and emotionally prepare for rates to be high until 2025.
Right.
You learn to get back to the basics into your business, grind things out, and make it happen, because the biggest opportunities, and we've been saying this in, as friends and in, some emails and text messages, your biggest opportunities are actually happening over the next 24 months while things are not as peachy as you want them to be.
Right.
So I think we just emotionally prepare and, physically prepare that, it may not change. It may be higher for longer. And if it changes earlier, great. Until then, build yourself an amazing business.
Well, and I think, you picked up exactly where I hoped you would. I mean, that's the point, is that we plan on it being higher for longer because we need to be prepared for a longer battle.
Bingo.
And that means you need to, it's like if you think it's going to be, a short winter, you're not going to pack away much food, Well, this is going to be a cold, dark winter, and it may last longer than you think. And so we should be prepared for that. But there's optimism here too, which is, I started my career in the late 90s, and it was kind of like this. Rates were in over 8%, and it was not a great market. And I found myself out there brand new to the mortgage business. And so I'm out calling on real estate offices and doing the thing. And as soon as things all of a sudden, and guess who else was out there? I talked about this in my last episode. The other people out there were the best people in the industry because they had to, because that's basics.
Yes.
But as soon as the market shifted a little bit, they all went back to work in their database or wherever their refis were coming from, and all the realtors were left with me.
Yeah.
And they were like, "Look, you didn't leave us." I'm like, "Well, I got nowhere to go." But my point is so there's silver linings in a market like this, but you're right. We all have to be out there, doing the basic fundamentals. And if you didn't watch last week's podcast, you should watch it, because it's like, look, if you don't love this industry, you're probably not going to make it.
Yeah.
You got to love it right now, because it's a passion project, But the good news is that even in the worst of markets, we say, oh, the market's down, there's low inventory, there's no sale. Someone's doing business. There's people doing business.
Bingo.
Yeah.
And I think, flip it around too. The last time when the market was, when we went through the Great Recession, everyone's business was much worse than this.
Yeah.
Much worse. And the loan officers who plugged in and stayed in, and the real estate brokers who plugged in and stayed in, what happened was, as that market started growing and transitioning, their business exploded. And so take territory, take market share today, make those connections, go build those relationships, because as your business and the market grows, if you have 1% of the market, and that's 1,000 transactions, well, all of a sudden you have 1% and it jumped to 5,000, your business just grew significantly.
Yeah.
Your job is just to go build those relationships, those connections, and work it. And I love with what you just said too. Real estate, you have to have a long-term vision for your goals out of it, and you have to have a long-term plan, because it's beautiful when it's going up, it's painful when it's going down, and everything's just okay when it's going sideways.
Right.
But you got to be able to deal with your emotions and your cash flow and the changes in expenses through all of that, because it's not if it's going to happen, it's when it's going to happen. And it's always done that, and it will always continue to do that. The mistake that loan officers have made and that real estate people have made is they assume this last 5-year hardcore bull run was normal.
Right.
And it was going to last forever. When you look around and you're in real estate and you go, holy cow, I'm making a lot of money, and man, things are cooking and they're on all cylinders and it's working really well, start socking cash away, because a transition is coming. It's always coming. Markets have to cycle. And it's a good thing. that you want them to cycle.
Right. Well, I think that it's, I think of 2020 and 2021, like, as someone who's a boater and I deal with tides.
Yeah.
Okay. So, sometimes I'm on a beach and, around here in the Pacific Northwest, there's like logs and debris and stuff and mostly rocks, not sand, but I'm talking about the logs for a second, but I'll be at a beach and I'll look up and I'll be like, how did that log get all the way up there? And it's because sometimes there is some massive high tides.
Yep.
And it moves the debris to a place where on any normal day, it's never going to hit there. And we were at high tide, like the highest of high tides for almost 2 years.
Yep.
And it really did change people's perspective into thinking, well, that's where the water line always is. And it's like, no, once in a lifetime or twice or 5 times or whatever the number is, not very many times the water line hits there. Most of the time it ebbs and flows between here. And that's what you're saying about the normalcy of the market.
Yes.
It can be great though, just don't get used to it being there,
Don't let, to use the water analogy and the tides, just don't let your expenses, your personal expenses rise proportionate to the tide.
There's that. There's that.
All we have to do is control that, but also flip it over. Inside of every market like this is massive opportunity. And I want to say this again because there's massive opportunity for you to recruit as a real estate person to your team. There's massive opportunity to go get in business with other good loan officers, for you guys to recruit amazing people. Flip it over. There are real estate deals happening everywhere right now. We just did a deal, 10-year owner financing.
Right.
I have not seen a 10-year owner financing deal since 2013. It was a decade ago. And so there's little things that are popping up that you just wouldn't normally see. But you've got to be out there in the water, in your boat, actually looking for something. Yeah. You can't just keep it in the harbor.
Well, I wasn't going to ask. This question just came to me. I'm just curious your thoughts as someone, who at a real estate office, like, do you think it'd be crazy for someone to get into real estate right now?
No. This is the best time to get into real estate.
Unpack that for me a little bit.
Okay. When you get into real estate, when the market is shooting up, you believe that's normal, and so you form bad habits. When a market isn't perfect, and we are in what I would call a transaction recession right now, so the Seattle Metro is down about 25 to 30% in total transactions, which is a ton.
Right.
Okay. Prices have stabilized and prices are going up. Okay. So we're down on the transaction side. But if you get in right now when it's hard and you can figure out how to make it work today and get the skills to survive and thrive in a hard market, the second it gets easier, you just kill it.
Yeah.
And you rise, but you disproportionately rise relative to the competition.
Yeah. I feel like that was my story. I didn't know what I didn't know when I got in the business. Yeah. Well, and we just saw Dan in the hallway. I mean, he started in 2008, like crazy guy. But, look at what it did for him, learning those disciplines that was necessary, in that kind of a market.
And so when a market transitions, very simply, it becomes a skills-based market. It becomes a contact sport. And it becomes, what am I willing to do to make those contacts, get those appointments, make my connections, and get in front of people? That works for lenders, for agents, and for investors. It's all the same. You're going to have to put in more reps right now. That's okay. The skills you get right now are going to pay you over the next 5 to 10 years. Just look at this as, cool, I'm getting paid to get better.
Yeah. All right, so I want to pivot a little bit. We talked on, one thing I did want to point out. We're talking about all these things that could cause more inventory. Just so everyone is fully aware, like less inventory came on week over week last week nationally. I don't know what it was locally. Maybe the numbers locally, but there's nothing solving or creating a tsunami of inventory. Matter of fact, there's less. There should be, like, normally inventory peaks. New listings was down, is what I was saying. So inventory normally peaks between July and August or
Yep.
somewhere in that area. This year is no different, although it's not as high as it was last year, nor was it as high as it was the year before. But listings month over month were down as well, which is normally you would see listings still going
Rising,
up,
yes.
rising right now. And so that's a little scary to the inventory issue.
The Altos Research does a phenomenal video where they talk about the new listings and home prices and stuff like that. And they put one out like once a week. They said everything that you just said. And you can also go look at the Redfin Data Center. They publish all these numbers, and then you can click through the major metros. Those are two things I like to look at when I'm looking outside of our market.
Alto, yeah.
Altos Research, Redfin Data Center.
So here's something for you guys that I don't know what I was reading, that I just wrote this down. I thought it was interesting, that the peak of inventory in the United States in 2023 was this most recent week, Stata, which was 448,599.
Yep.
And in 2015, in contrast, that number was 1.2 million. Just
3x more.
yeah, a third. We're at a third of where we were in 2015 with inventory. So anyways, I thought that was an interesting stat. Another thing that came up in something I was reading that I thought was relevant, and it goes back to the affordability thing, which is the average homeowner's DTI is peaking close to 40%, which is their debt to income ratio peaking 40%. Obviously, part of that has to do with just home prices being what they are, but also
mortgage rates
and mortgage rates, but credit card, payments and stuff like that going up. So there's a lot of pressure there. But I don't think that the rents are going to be the solution. You know what I mean? I still think that home ownership for most people is going to be the best way to go if you can afford to buy a home. So I want to pivot a little bit from that conversation. And as we get close to wrapping up our time together, I want to talk a little bit about investments and where you see the opportunities are. You just mentioned one, which is, seller financing,
Yes.
some unique properties out there, things like that you could put together deals on. But what are you seeing is the biggest opportunities for people? Has it shifted since we last spoke? What are you seeing on like fix and flips, land development, those sorts of areas? Where's the biggest opportunity for people if they want to invest in real estate?
I think your biggest opportunity right now is in land development, new construction. Your second biggest opportunity would be to flip a home or install like a manufactured home or something like that. This low inventory environment, and once again, you can go look up these stats from the National Association of Home Builders. When that new construction starts to make up, 20% of the market, that's creating massive opportunity. And then also realize that the majority of that is made up by the big builders.
Right.
So for guys like us, that means if you went and did a 5-lot development or a 10-lot development, you don't have competition from D.R. Horton to buy that piece of land. So you can cut right underneath the big money and create opportunity for you and your family. So I think that is your biggest opportunity. Other opportunities that are popping up is seller financing. Seller financing is popping up because you have people who still want to or need to sell, who may still want some type of cash flow. So that owner financing that we got, that was on a fourplex. The individual was just tired of being a landlord. So all of these COVID restrictions, all of the things that slowed everything down, the new landlord-tenant law had just worn this guy out. But what did he still want?
Cash flow.
Cash flow. Well, sir, do you want to carry the paper? And he goes, you know what? Let me talk to my wife. I do if she does. He calls back 30 minutes later. I want to carry the paper on that. Would you be willing to carry it for 5 to 7 years? Calls back and goes, 7 years. And I go, what if there was a $50K balloon? Would you go for 10? Hangs up the phone, calls back. I would do that. So right now it's just about asking. I think as an investor,
What kind of rate?
4% year one, 5% for the remaining 9. 50K balloon at year 7 to get 8, 9, 10.
Why didn't you bring me that investment deal? I'm just kidding.
We do, a buyer presented it, said, "Hey, can you call on this property?" And before I realized it, I had hit a grand slam for
That
this
is
buyer
phenomenal.
and not for me and my homies.
Right. Yeah. That's awesome. Well, so you make a good point, right? You don't know until you ask.
You don't. So, but this is a market where you should be asking. We need to get really involved in the needs analysis. There's going to be more multifamily that's going to pop up because there's $1 trillion worth of multifamily debt that's coming due in the next 2 years that's in some type of bridge financing.
Right.
And that multifamily was put under at a lower rate and a lower cap rate. And some of those cap rates have expanded, and we know interest rates have gone up. So those are going to require cash in refinances, or they're going to have to come to the market. So there's going to be some larger multifamily plays in there. That's a patience exercise, and that is a
So
calling.
you're thinking like 5 to 20 unit type of stuff?
Yeah, I'm talking 5 to 5,000. Anything that's in that commercial debt category.
Okay.
The 5-unit person's probably okay. It's probably going to be more like 20 and above.
Okay.
Because then the dollar amount starts to get so big that, I need 5% more in equity. 5% more in equity across 5 units may only be 50 grand. 5% more in equity across 20 units all of a sudden might be 200.
And this is mainly because the cap rates have changed.
Cap rates have changed and interest rates have gone up.
Yeah.
So in order to meet their LTV requirements and their debt service coverage ratio requirements, the debt service coverage ratio is essentially they've got to be like 1.2 or 1.25 greater than the net operating income. Okay. Well, if expenses have gone up and that debt service went up, that means that net income went down.
Yeah.
Plain and simple.
Yeah. Simple math.
Simple math. Industrial is still really hot, especially in our area here in the Seattle metro. We've seen no change in it, and small industrial sells for stupid numbers. We just sold one here a little bit ago, and I mean, we sold it at like a 3.5 cap. Like, that's ridiculous. So I think if someone could build a small industrial building or site.
Make a warehouse.
Warehouse, exactly. And I'm talking a 2,000 to a 10,000 foot warehouse. The bigger warehouses the larger industrial developers are building those, the 50,000, 100,000. But there's that smaller part of that market's not being serviced very well. Office is still really beat up. Stay away from office.
Yeah.
Unless you're going to owner occupy it and they've got like AAA, awesome tenants. Also, and this really applies to Washington State. Washington State's passing of the middle housing law is going to create ADUs, duplexes, additional dwelling units, and detached additional dwelling units, duplexes and fourplexes, unlike we've seen before. And that is a Washington State specific opportunity. Dig more into that. That's going to be a good money maker. And also, because there's fear, there's just less investors hunting.
Right.
Everyone else stopped hunting, so today is the day to start.
Yes. I'm ready, Anton. You find me the deals. And I'm still an investor in real estate, and when the right opportunity presents itself. This market, I was there in 2008. I can just look around, and like I said, look, there's no question that there's some validity to all of these individual items that we mentioned could have an impact on the market, just like unemployment staying strong has had an impact on rates coming down that we didn't foresee. So there's no question. I wouldn't want to be here and I wouldn't give this advice to any of my clients or anyone else that asked me, that there's no way that anything changes with the housing market. But the reason why I wanted to have this episode and why I thought this would be fun to do is because if you go and watch anybody whose intent is to take 1, 2, or maybe even 3 different data points that they then build a story specifically around those that convinces you that the market is going to crash. I thought it would be fun for us to talk through each of those topics and why it's not realistic that that's going to happen, at least based on, and I've watched these, I made a point. I'm like, I'm going to do a podcast on this. I'm going to go watch some of these guys and what are they saying? And none of it to me added up or was missing significant data. The other thing we didn't really talk about is that as certain things happen, there's an inverse thing happening as well. And like employment being one of those things. So for example, if unemployment goes way up, could that lead to foreclosures? Yeah. But it would also mean that the Fed would stop raising rates and mortgage rates would come down. Well, what would that mean? Well, that would mean that more people would, be willing to sell their home or refinance that already have it. It would bring affordability down. It would move so many of these things. And so all these things are not just, static, things that you stick around. They're like swirling around like the universe, and they all have impact on one another. And so we can stop and pause and look at one of them and say, okay, well, is Airbnb really going to flood the market with inventory? Well, that's a little bit ridiculous. Here's why. It's 1% of the market. Okay. But once you kind of unpause, it's still just a piece of all the data that has to be consumed. And for someone who lives it and is in it, I can see validity in some of these points, but none of it speaks to, there's a huge crash, because at the end of the day, you guys, there's not enough houses to house all the people.
Yep.
Period. Yep. There's just not,
And don't take our word for this. Go home, open up a Google Doc, go start tracking 20 properties in your area. So let's just say you're going to be an investor or you're going to be a home buyer. Go track 20 properties. Just type in the address, the square footage, the bed, bath, and the asking price. And then let them sell. And then go type in the what they sold for, and follow a little part of a neighborhood or a part of a city, and just follow everything that goes active, pending, and sold in there, and watch it over a 30, 60, 90-day cycle. And you'll prove to yourself what direction that local market is moving, and realize one of the most telling things about a market is how quickly things go pending and the new asking price. So the new asking price, one thing that people don't realize is when active inventory hits the market, that's telling you which direction the market is going by the new asking price. And then it's confirmed by if it goes pending in a reasonable amount of time, aka DOM, days on market. And then it's reconfirmed by the sales price. The list to sales price ratio here in the Seattle Metro is over 100 again, which means the average home has a bidding war.
So the whole episode we did about getting points from the seller, it's over.
It's gone.
It's gone.
That was fun in Q3.
We told Q4. You that was a short window. We told you.
And you know what? It is still happening. Let me flip this around, because this was a discussion we had with our real estate sales team. Even with that happening, I'm still seeing very skilled real estate agents grab points from sellers. And so this goes back to the skills-based market. Even though there's bidding wars happening, I'm seeing extremely skilled agents get way more for their clients than the unskilled right now. And so if you don't have those, go to the class, go brush up on it, work on your negotiation skills. Because so last week, one of the guys on my team, and this was with a VA buyer, he was the lowest with the least amount down, and the seller was not VA, so it wasn't like, I love you.
Right.
Got the deal. And he got the deal because he over-communicated and just followed up and followed up and followed up. And there were other offers, and so he was, I think, $8,000 or $9,000 less than the highest offer with the lowest down payment.
That might be a fun conversation to have one day, is the skills that differentiate a top performing realtor.
Yes.
I don't mean a top performing as far as volume goes, because whatever, but usually they probably are top performing. But like, what is a good negotiation? Because like I've been in deals with you where, you know, you're like, hey, I'm going to call and I'm going to say this to the seller, or I'm going to call the agent. I'm just going to tell them this really quick. And I'm like, why would you do that? And you're like, well, because in 2 days from now, we're going to do this. And, and I want to plant the seed about that. And it's like, you know, there really is something to be said, I think, for the art of negotiating the deal. And there's a lot of subtle ways to do it. And it can help do what you just said.
Well, here's the crazy thing. You have to realize as real estate brokers, so this doesn't apply everywhere in the country, but I know it does here in Washington State. Our batting average is public.
Right.
It's called a list to sales price ratio. And so you can see our batting average on the buyer side or the seller side. So you can see which agents are actually statistically outperforming the market. And the ones that do, very simply, they figure out a plan that works for the buyer and works for the seller, and they build a bridge. It's an art, you know, and they're really good at asking questions. They're good at understanding personal details. We can go into a whole episode just about this.
Well, we probably should.
But they build a bridge. Neither party gets exactly what they want, but they build a bridge, and it's amazing to watch.
Yeah. Well, I love the science behind all of that. Well, Anton, I appreciate you coming on today, you know, and it was like one of our conversations we have about the market, and we just kind of get to banter back and forth. I hope that you guys enjoyed this, because I have to believe that if there are things that are interesting and top of mind for us who are in this business every day at a high level and leading teams and managing teams of people doing this, I have to imagine that it's of interest to all of you. And so if you have thoughts, comments on the things that we said, please leave them in the comments down below. I'll obviously like and subscribe to our channel, because not only does it help us rank on YouTube and the other platforms, you know, we're on all the platforms now.
Awesome.
So they might be watching us, or listening to us on one of the podcast platforms. So we're going worldwide here at Market Shares, and we appreciate your support. I appreciate you, Anton, and we'll see you on the next episode. Take care.
Thanks for having me.